Hello, everyone, and welcome back to another episode of Advisor Insider. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com, and I'm talking today with Daniel Satiroff, Senior Analyst at Morningstar. We're going to be talking about ETF share classes. The mutual fund industry has been pushing for these things for a while. There's a really interesting backstory there because Vanguard has had a unique advantage, I guess I should say, because they kind of created this thing, this ETF share class for mutual funds. As of now, they've been the only mutual fund company or ETF company that's been permitted to have these things. But a whole bunch of mutual fund companies have applied to the SEC to get, I guess, the same kind of exemption. But we're going to let Dan break it down for us. Dan, how are you doing today?
Doing great, Jeff. Thanks for having me on.
Yeah, thanks for being here. I know you and I had a conversation a week or so ago about this, and
hmm
I just thought we got to dig a little bit deeper or have some of this stuff presented in your own words. But first, tell us what we're talking about here. What is an ETF share class?
Yeah, it's a good question, and I think for people that aren't, watching this day to day or whatever it is like me,
Mm-hmm.
that it's probably a little bit more in the esoteric area. So the best way to think about it is maybe just with a very simple example, right? So let's say we've got Jeff's mutual fund, right? And you've got multiple share classes and that are effectively just gateways for people to sort of get access to your management. So you may have A shares, B shares, you might have an institutional share class, right? They all have sort of different fees or maybe different investment minimums aimed at different target markets like retail, institutional, et cetera. So what the ETF as a share class essentially does is it adds another gateway or another way to get access to your management in this pool of money that is already a mutual fund. So
Mm-hmm.
but instead of being a mutual fund share class, now it's a little bit different in that it's an ETF. As we know, ETFs, today. So there's some nuanced differences there, right? The ETF is going to trade throughout the day, whereas the mutual fund share classes are not going to trade throughout the day. They're just going to strike a NAV at the end of each day.
Mm-hmm.
The ETF is a little bit more tax efficient because it has that creation redemption mechanism. Technically, that exists with the mutual fund, but it's almost never used in practice for practical reasons. So there's some nuanced differences there, but the big thing to think about is just sort of as a gateway to get into sort of that pool of money that the manager is managing behind the scenes. We've already had that with multiple share classes today. Most mutual funds, excuse me, have multiple share classes. The ETF is essentially just being bolted on as a new share class. So it's
Yeah,
really more of a structural nuance here that we're talking about. It's not really we're not reinventing the ETF or reinventing the mutual fund. We're essentially just merging them together at the end of the day.
right. So mutual funds, as you kind of explained there, Dan, mutual funds have multiple share classes for various reasons. Some are institutional share classes, some have different types of fee structures. But the ETF is just essentially an ETF. It operates just like an exchange traded fund, but it's working on the same pool as the mutual funds, right?
Correct. And that's the big takeaway here is like at the end of the day, it's all pointing toward the same pool of money behind the scenes.
Okay. So talk about the Vanguard story, how Vanguard has this unique exemption ability. That's the only company that's allowed these right now, right? These
Right.
ETF share classes.
Right. So you have to go back to the very early 2000s. I think Vanguard, the timeline here is a little messed up. It was somewhere around 2000 to 2001. Vanguard applied for kind of what you said. The term is exemptive relief. Basically, they need the SEC to bless this ETF share class, meaning they can go out and use it in the world. So Vanguard went to the SEC, said, "Hey, we want to bolt an ETF onto our existing mutual funds. We think there's some benefits there for investors." The SEC granted them permission to do that on their index funds only, not on their
Mm-hmm.
actively managed funds. So that's another part of this story. So it was only allowed on their index tracking mutual funds at the time. And the first mutual fund to get the ETF share class would have been Vanguard Total Stock Market, which we now know as the Vanguard Total Stock Market ETF, ticker VTI. That came about in May 2001. And then
Mm-hmm.
over the years, they slowly started rolling it out onto their other index tracking mutual funds, where we're at today, where I believe almost every, if not every, Vanguard index tracking mutual fund also has an ETF share class of it. And as you said, they were the only ones that the SEC sort of allowed to use this. The other caveat there is that Vanguard also had a patent on this stricture. So even if the SEC were to give somebody else their blessing to say, go ahead and use this, they couldn't because Vanguard sort of had a monopoly on it. So that sort of changed in May 2023. That patent expired. And so now where we're at is you've seen all of these other asset managers that sort of want access to this because they're starting to understand, the tax benefits that that ETF share class can have.
Hmm.
So what they're doing now is they're applying to get that share class to also get the SEC's blessing. So yeah,
Okay.
that's kind of where we're at today. I think we've
So
had somewhere around 35, if I'm not mistaken, 35 applications for that.
one distinction, though, that all of these 3 dozen mutual fund companies that have applied to the SEC for the same kind of share class approval have all been they're active managers. It's an active management application, right?
Yes, that's correct. It's been largely active managers that have been applying for this. I assume that they're mostly targeting or intending to apply this to their actively managed
Right.
mutual funds. A big part of the reason I think has just been the trend that's sort of developed over the last several decades, right? Like a lot of indexing strategies are already in ETFs, so there really isn't a need to bolt an ETF on, right? They're already there. So I think it's just sort of like it's just is what it is. The next big frontier would be applying this to actively managed mutual funds from here on out.
Hmm. And Vanguard itself applied for exemptive relief to do this for its active strategies, right? At one point.
They did. I don't know when the exact filing was, but I think it was around 2015 when the SEC actually came out and actually ruled on that, and they said we're not going to allow you to use this on your actively managed mutual fund. So there's been an attempt already at this, I guess, is the main takeaway, and
Right.
and it was denied. Yeah.
And as I understand it, that's the last time the SEC has done any ruling at all on this issue, right? They
Yeah,
haven't
that's
ruled on
correct.
all these filings that have been flooding in since May of 2023.
Right. As far as we're concerned, or at least from what I can see, they've been quiet. Like there hasn't really been any communication publicly addressing this at all. I
Uh-huh.
suspect there's probably been some back and forth behind the scenes with asset managers. We know that the first filing that came through was from a firm named Perpetual. And I believe the SEC contacted them with some comments, and they didn't return those within the required window. So their request was actually withdrawn for that reason. But that's the only one. That's the only sign that there's been any contact between asset managers and the SEC so far. Everything else has been pretty quiet on the surface.
Hmm.
So it's a little bit
What,
of a guessing game as to where this is heading, I guess.
what is your take on why Vanguard would be allowed this loan approval? You would think that the SEC would at least give the same exemptive relief to
Yeah,
other asset managers that they've given to Vanguard.
I don't think it was intentional. I think it was sort of an accidental thing. I think Vanguard, figured out this would be a good idea. They applied for it. The SEC gave it to them, and then they had the patent on it, right? So nobody else could really apply for it, and that was sort of case closed at that point.
Hmm.
That was really, I think, what stopped it was I think that was the patent really. I just don't think, if we go back to 2000, 2001, this was that big of a deal at that time. You have to remember, like, ETFs were still kind of a novelty. They had only been around for, like 7 or 8 years at that point. People were still trying to figure them out, get confident with them, understand how they work, that sort of thing. So there were definite advantages there. People just, I don't think in this industry really saw where it was going to go and how big that was going to be, ETFs in general were going to become over the subsequent, 20 years or whatever. So I think it was probably just a little bit of oversight on everybody's part, and Vanguard just kind of got lucky and was in the right
Hmm.
place at the right time and made the right move. So this is one of those things I kind of just chalk up to being, in the right place at the right time.
Okay. Now, just to be clear, the companies that have applied for the ETF share classes, they're not small companies. These aren't
No,
fly-by-night operations or anything like that. They
right.
clearly see something, an opportunity there. Why are they applying? What do they see as the benefit of having this ETF share class on their mutual funds?
Sure. So, I think it goes back to trends we've seen developing over the last couple of years, right? There's clearly been a lost appetite for active management and specifically active management in mutual funds, right? They're not very tax efficient.
Hmm.
So what happens is, active management isn't performing well. People leave. If enough people leave, that forces the manager to essentially sell positions to meet those redemptions. And then what happens over time is those capital gains have to be distributed to shareholders. So you're in a mutual fund that isn't performing well, and you're getting saddled with capital gains distributions every year, which you have to pay taxes on. So that's been going on for a few years now, and one of my colleagues just wrote an article on this. We're seeing like some really, really high levels of capital gains distributions coming out of mutual funds. We're talking like 20, 30, 40%
Hmm.
capital gains distributions. It seems to be getting worse every year. So that's a big reason that bolting the ETF on to a mutual fund essentially gives you that sort of creation redemption mechanism on a mutual fund now. So you can purge any potential capital gains that are sitting in the mutual fund share classes through that ETF. So
Hmm.
that's a really, really big carrot that they're going after. And that essentially just makes your fund that much more palatable. If you can give somebody a much more tax efficient experience, my guess is they're probably more likely to stay. And it potentially, curbs, if not, stops a lot of these outflows that we're seeing from mutual funds. I think that's part of the problem. I don't think it's going to solve the complete,
Right.
exodus from mutual funds, but it would certainly be a pretty good step in that direction. So that's probably the big thing, I think, from an asset manager perspective, is they're really going after the tax efficiency to hopefully help curb some of these outflows that they've been experiencing for the last several years.
So the mutual fund companies would benefit, although
Hmm.
might not be the full benefit they need or want as far as stemming outflows. Do investors also benefit in some way? Because they
Yeah,
already
it's
have the access to the ETFs, right?
well, yeah, they do, but I mean, think about it. They have to sell out of the mutual fund, which you're going to, in theory, you realize a capital gain when you do that. That's a
Right.
taxable event, and then you would have to buy into an ETF in order to get, the tax efficiency of the ETF. So they still benefit in the same way from that more tax efficient structure being added to the mutual
But
fund.
the mutual fund investors would also benefit, right?
Yes, it's a
Okay.
shared benefit. Yeah,
Okay,
exactly.
so from a mutual fund investor perspective, you would benefit because this would essentially, as you said, purge the capital gains distributions through the ETF. So
Hmm.
the mutual fund company would likely benefit because it would make their mutual funds more attractive from a tax management perspective.
Right,
And an ETF investor would just be like an ETF investor, that
right.
nothing changes there. Now, who loses here?
Well, it's not exactly there is a caveat to the ETF share class. So you share the benefits of the tax efficiency. There is sort of a fringe case where you also share the disbenefits, I guess should say.
Hmm.
So if you have a situation where, let's say, the mutual fund is going to distribute capital gains and there just isn't enough trading activity in the ETF to actually purge those capital gains, the ETF investors could end up with capital gains distributions. That sort of circumstance, there's a lot of things that sort of have to come together at the right point in time in order for that to happen. And
Hmm.
it's only happened once that I know of. That was around 2008, 2009. One of the Vanguard I believe it was a long-term Treasury mutual fund, ran into that situation. It's very rare that that happens. That's the only instance that I know of.
Hmm.
So there are sort of like, risks at the margin of those sorts of things happening, but it's very, very rare. The other downside, and this is one that is probably not discussed frequently enough with just actively managed mutual funds, but it's really sort of a capacity control issue. So if you're an active manager, right, you have a limit on how much money you can manage before you sort of lose your edge, right? Your trading and your stock picking essentially starts to push stock or bond prices around, right?
Uh-huh.
So if you are, and this varies depending on your specific strategy. So if you're like a closet indexer, you're only taking like 1% tracking error relative to the market, you've probably got a pretty big capacity. If you're like a high conviction active manager, you're holding 20 or 30 stocks, you probably have a relatively low capacity. So there's a big spectrum out there. But when you bolt the ETF share class on, you effectively lose your ability to shut your fund down. The ETF is going to trade no matter what. So you can't you lose that lever to actually shut off new money coming in and further eroding your ability to actually provide an edge to the existing investors. We know active managers do that today. There's a number of them that actually do shut their funds down to new money to maintain their edge and protect the existing investors. So that's a consideration that you definitely have to take into account. And that's why like this ETF as a share class thing, it's not going to work for every active manager out there. And that's probably the biggest one is you lose that ability to shut off the flow of new money coming into your mutual fund.
I wonder if there's one other loser here, and that might be what is kind of has the SEC sitting on its hands on this topic is the tax revenues to the federal government. Capital gains distributions equal taxes, and
Yep.
this would be essentially a way around capital gains distributions. Is this something the SEC potentially is or should be considering when it follows its mandate to look out for investors and manage the markets in its regulatory capacity? Should it be looking at the impact on tax revenues?
Possible, and I've heard that story before. I think the other thing you have to consider here is that, we just with, going back to that trend I was describing where money's leaving mutual funds and going into ETFs, like the
Mm-hmm.
long-term direction of all of this is that investors are already moving into more tax efficient investment vehicles, mainly being the ETF, right? So that's the long-term trend. So to the extent that they are sort of holding back on this for tax revenue purposes, it's I see it as more of a short-term gain, right? It's probably going to last, a few more years, maybe a decade, whatever it is. Eventually it seems like is moving over to the ETF, and there's just going to be, less money in mutual funds. So
Uh-huh.
it's a question, but again, they're just sort of slowing down the inevitable, I guess is the way I see it if you look out over like the next 10 to 20 years, something like that. So it's a fair question. Again, it's a point I've heard before, but
Mm-hmm.
they've also approved the ETF, which is this massively tax efficient vehicle, and it's out there and everybody's going after it. So if tax revenues were really the long-term play here, they've made mistakes in the past. Let's
Right.
put it that way, just in approving the ETF structure, period. So
Okay.
so yeah, it's a fair question. Again, the long-term direction I think is everybody's going toward just the more tax efficient investments. So
Mm-hmm. What's your outlook for this ETF share class? I know like I said, we talked earlier last week, I think it was, and you said coming into the year, you thought this was going to be the big issue of the year,
yeah,
and obviously it got kind of overwhelmed or overshadowed by the crypto ETFs and
yeah,
a few other things, but it's kind of been forgotten, but it's still there, and
yes.
companies are still applying. I still see these things come across in my press releases and stuff, and people are, in the filings, people coming across, filing for this ETF share class. So it's not going away.
No. Yeah, like you said, I thought this was going to be the big story of 2024 as far as, asset management went.
Hmm.
Like you said, we've had some hiccups along the way, being like the crypto ETFs were kind of, sucking up all the information share at the beginning of the year.
Right.
And then, we had an election this year too, which was a kind of a big distraction for everybody. And now we have a new administration coming in, and that inherently means, changes of leadership across a lot of agencies, including at the SEC, it looks like. So I think given all that, I think a lot of this might just be shelved until we get new people and new leadership into the SEC and the other agencies and stuff that are going to be looking at this.
Hmm.
So that's probably the big thing. The conversations I've had with asset managers so far, it seems like they're all positive that this is eventually going to get approved at some point. That's
Hmm.
just, their take on the situation. I'm of the opinion that this would be a good thing for the right mutual funds, right? Again, you need to go back to like those other considerations, like are you a manager that has pretty good capacity, right? You're not going to run into any capacity issues, down the road. Um, is this something that there's actually appetite for that you could actually sell an ETF share class? Because again, you actually need money in the ETF share class, and that ETF actually needs to trade in order to give you the ability to purge those capital gains. So you do have some considerations there, but I think there are actively managed mutual funds out there that this could actually be a benefit for the right ones. So I definitely would like to see it. It would definitely be a help to the end investor, right? They would definitely get a more tax efficient experience at the end of the day. But we'll see where it goes. It's one of those things. I think it's going to work itself out here sooner or later. But the first thing we got to get through is we got to see if the SEC actually approves this first.
Hmm.
And again, going back to what asset managers are saying, it seems like they're positive on it. So I'm hopeful we get something in 2025. Fingers crossed that nothing else comes up. But yeah, it sounds like asset managers are positive, and it's something I would like to see approved for the right funds in the right circumstances.
So what happens if it does get approved? Because I'm assuming what we would see is a flood of ETF share classes bolted onto actively managed funds. So
Yeah,
could this mean we'll see ETFs that we don't, or I'm sorry, investment strategies, actively managed investment strategies that ETF investors don't currently have access to?
that's a possibility. Although I tend to think some of the stuff that just, they don't have access to right now, they probably don't have access to for some reasons, right? It might be closed to new money. Those types of strategies, I think, are going to be more capacity constrained. So those are probably not going to be good candidates for the ETF in general. And the fact that it's a closed mutual fund tells you that the people that are managing it are pretty savvy and they probably aren't going to put an ETF on. It's very possible that, yeah, you could see a flurry of new ETFs coming out. You probably very likely will, on all sorts of stuff that we just haven't heard of, in a long time.
Yeah.
Um, it's going to be interesting to see what happens there. The other ones, the ones that are really suited for this that I think are really going to do well are the things that are like the closet indexers that have the great brand name and the great distribution. You think of like the bigger asset managers that are out there that are pretty popular with everybody. Those are the
Hmm.
ones that I think are going to do particularly well because they've already got the distribution and the marketing and the connections and everything down. Once you get into the ETF world, it is an immensely competitive environment, right? It's so difficult. I did a study on this like earlier this year. I think at the time there's around 3,400 ETFs at the beginning of the year. I think like half of them had less than 50 million in AUM or something like that. That just gives you a taste of like how difficult it is to be really successful in ETFs. As big as ETFs are, and for all
Hmm.
the trillions of dollars that are behind them, it's really, really hard to launch an ETF and be successful with it. And it'd be the same thing here. Essentially, you're just bolting on a share class and creating an
Hmm.
ETF on an existing mutual fund. So, and that's why I say I go back to, like just getting investors' attention earlier. It's like, are you actually going to be able to sell this? Is this actually going to make sense? From just a distribution and marketing perspective, it's really tough. It's really,
Hmm.
really tough.
All right. Good stuff. We're going to keep an eye on this, Dan. We will definitely be talking to you again, probably on this podcast as this thing unfolds. Because, like you said, I don't think it's going to go away. Whenever I see the biggest and most significant asset managers all doing the same thing, you got to kind of assume there's movement coming.
Yeah.
Sort of like everybody filing for a Bitcoin ETF.
Yes. Yeah.
This isn't like a one-off thing. There's a lot of money behind this with 35 or 36 giant
Yeah.
asset managers now applying for a ETF share class. So it should happen. I mean, I shouldn't say it should happen. It likely could or will happen maybe next year when we've got a different makeup in the SEC. Who knows? I still think the tax thing is the big snag at the federal government level. I don't know if that's supposed to even be a consideration for the SEC. you know how it is. It's all fungible. You know what I mean?
Yeah.
The oversight of the federal government is fungible. Everybody's got to be at least thinking about the same thing and some of the same things. Anyway, on that, I want to leave it. Daniel Sudaroff, Morningstar Senior Analyst. Great talking to you. I want to thank you for being here. I want to thank everyone for listening. My name is Jeff Benjamin with ETF.com. If you want to reach me, my email is jeff.benjamin@etf.com. Don't forget to go to etf.com and check out all we've got there for you folks. For financial advisors, we've got the Advisor Center with stuff designed specifically for you. Thank you very much. Talk to you next time.